calm, confident, skeptical. Small-cap funds promise the fastest growth, the biggest upside, the next multibagger. And yet, some of the smartest investors quietly walk right past them. Not because they hate returns, not because they're scared of risk, but because they've done the math. Here's the uncomfortable truth. The same thing that makes small caps exciting is often what makes them dangerous. Right now, small cap funds are everywhere. They dominate top performer lists. They flood investment apps. Social media is full of screenshots showing insane returns from the last 2 or 3 years. And to be fair, those numbers are real. After major crashes, small caps always explode upward. They did it after 2009. They did it after 2020. Which makes the question unavoidable. If small caps grow faster, why don't smart investors put most of their money there? To answer that, forget the marketing, forget the fund names, forget the star ratings. Let's talk about how this actually works. A small cap fund doesn't buy future giants. It buys small companies. Companies with limited cash, limited access to credit, and very little room for mistakes. In good times, that fragility looks like speed. Profits jump faster, prices move faster. But in bad times, fragility turns into free fall. Here's the difference most people never hear about. Large companies always have buyers. If a large cap stock falls, someone steps in. Pension funds, insurance money, global institutions that must deploy capital. But when a small cap stock starts falling, sometimes there's no one on the other side. Prices don't drift down, they gap. Down 5%, then 10%, then suddenly no bids at all. That's liquidity, and liquidity decides survival. Now comes the math nobody likes talking about. If a stock falls 50%, it doesn't need 50% to recover. It needs 100%. Small cap funds experience these drawdowns more often and deeper. Over long periods, many small cap funds don't beat large cap funds. They just feel like they do, because short bursts of extreme performance burn into memory. Volatility gets mistaken for skill. Here's the irony. Small cap funds often fail because they succeed. Money pours in, the fund gets bigger, but small cap stocks can't absorb massive money without distortion. So the fund drifts. It starts buying mid caps, then near large caps, still wearing a small cap label, but no longer behaving like one. The hype says higher risk equals higher return. Reality says higher risk often equals worse timing. Most investors enter small cap funds after the rally, when charts look perfect, when past returns feel irresistible. They're not buying opportunity, they're buying late. Smart investors don't hate small caps, they respect them. They treat them like explosives, powerful, useful, but dangerous if handled casually. That's why small caps are usually a slice, not the core, a tactical move, not a permanent home. So the real question isn't whether small cap funds can make money. They can, sometimes spectacularly. The real question is this: are you investing or are you renting past performance and hoping the bill doesn't show up later?